The live stock price for Kazia Therapeutics Ltd, trading under the ticker symbol KZIA, currently sits at 7.92 USD, reflecting a massive intraday surge of roughly 2.16 USD, or 37.59% as of this very moment on Wednesday, November 19, 2025. The market is witnessing an absolute frenzy of activity around this biotech microcap, with volume already exploding past 23 million shares against its typically thin liquidity. If you are watching the charts, you are seeing a classic vertical breakout that defies the broader gravity of the indices today. This is not just a standard volatility play, this is a violent repricing event triggered by data that forces every short seller and skeptic to scramble for cover. The expectation for Kazia Therapeutics, especially over the last few grueling months, has been one of grim survival. Investors have been battered by fears of NASDAQ delisting, a sub-$35 million market cap, and the quiet erosion of hope that often plagues small pharmaceutical developers. The street expectation was that KZIA would likely fade into obscurity or be forced into a toxic financing spiral to keep the lights on. That was the narrative until this morning. The reality, however, has just shattered that bearish thesis with a sledgehammer. What we are seeing today is the market reacting to a black swan event of the positive variety, a rare, almost unheard-of clinical outcome in one of the most notoriously difficult-to-treat diseases in oncology. The company announced that a patient with stage 4 metastatic triple-negative breast cancer, TNBC, has achieved an initial immune complete response, ICR, after being treated with their lead candidate, Paxalisib, in combination with immunotherapy and chemotherapy. To put this in perspective for you, and I cannot stress this enough, complete responses in metastatic TNBC are statistically anomalies. We are talking about a historical success rate of roughly 0.6 to 4% in similar clinical settings. When a company the size of Kazia produces a result that beats the odds by that magnitude, the stock price does not just tick up, it explodes. This disconnect between the market's expectation of bankruptcy and the reality of a potential best-in-class cancer treatment is what is fueling this 37% run. And frankly, if this data holds up in larger cohorts, today's price action might only be the opening act of a much larger repricing. While the headlines are dominating the discussion, we need to pause and look at the mechanics of this move because it is crucial for anyone trading this to understand the battlefield. You have a stock that was essentially left for dead, receiving a NASDAQ deficiency notice just days ago on November 12, 2025. The bears were comfortable. They were betting on the inevitable delisting or a reverse split that would crush equity holders. Then this news drops. The immediate result is a liquidity vacuum where sellers disappear and buyers, ranging from retail traders on Robinhood to speculative funds, flood the order book. This creates a gap-up scenario where the price has to jump significantly just to find willing sellers. It is the financial equivalent of a pressure cooker lid blowing off. We often see similar psychological setups in high-profile names like Tesla stock or even Nvidia stock when they surprise on earnings. But in the microcap biotech space, the volatility is magnified tenfold because the float, the number of shares actually available to trade, is so restricted. When you have millions of shares of demand chasing a limited supply, the price has no choice but to go vertical. However, one must maintain a level head. The excitement is palpable. But let's analyze the specific medical data driving this optimism. The patient in question showed an 86% reduction in tumor burden after just 3 weeks of treatment. That in itself is a remarkable velocity of response. But the follow-up scan, which confirmed the complete metabolic resolution of all lesions, is the holy grail signal. Triple-negative breast cancer is aggressive. It lacks the receptors that drugs like tamoxifen target, making it a wasteland for targeted therapies. Chemotherapy is the standard blunt instrument, and it rarely cures metastatic cases. For Paxalisib, a drug originally developed for brain cancer, glioblastoma, to show this kind of synergy with Keytruda, which is a checkpoint inhibitor, suggests that Paxalisib might be doing something unique to the tumor microenvironment, maybe making cold tumors hot so the immune system can attack them. This opens up a massive addressable market beyond just brain cancer, which has been the primary valuation anchor for the company for years. It's fascinating to watch how different demographics of investors process this information. You have the momentum traders, who are simply looking at the volume scanners on their Interactive Brokers trading platform or the Fidelity mobile app, seeing the percentage gainer and jumping in for the ride. They don't care about the science. They care about the tape. Then you have the fundamental biotech investors who are frantically reading the abstract of the upcoming San Antonio breast cancer presentation, trying to figure out if this is a repeatable result or a lucky N-of-1 case study. This tug of war between pure speculation and fundamental re-rating is what creates the intraday swings we are seeing right now. The stock hit a high of around $8.54 earlier and has pulled back slightly to this $7.92 level, which is healthy. It shows that profit-taking is being absorbed by new buyers who believe the story has legs. Before we proceed further into the pipeline analysis, I want to ask you, comment below how many shares of Kazia Therapeutics you currently hold, or if you are waiting for a dip to enter. The volatility here is extreme, so I'm curious to see how you are managing your risk in real time. Now, let's look closer at the company itself, because many of you might be new to the Kazia story. Kazia Therapeutics is not a brand new startup. They have been grinding in the oncology space for years. Their flagship asset, Paxalisib, is a brain-penetrant inhibitor of the PI3K/AKT/mTOR pathway. In plain English, this pathway is like a communication line that cancer cells use to grow and divide. If you cut the line, the cancer stops growing. The problem with this class of drugs historically has been toxicity. They can have nasty side effects. However, Paxalisib was designed to cross the blood-brain barrier more effectively than its predecessors, which is why it was targeted at glioblastoma, the most aggressive form of brain cancer. They have been running the GBM Agile trial, a major adaptive study, and the market has been anxiously awaiting final verdicts there. But today's news shifts the spotlight to breast cancer, specifically brain metastases from breast cancer, which is a massive unmet need. If Paxalisib can treat the primary breast cancer and the metastases in the brain, it becomes a dual-threat drug that big pharma companies would drool over. In addition to Paxalisib, KZIA has another asset called EVT-100-701, a VEGFR3 inhibitor. This drug targets the formation of new blood and lymphatic vessels that tumors need to spread. Think of it as cutting off the supply lines to the enemy. Recent data presented in 2024 and 2025 regarding EVT-100-701 in ovarian cancer has also been promising, showing signs of disease stability in patients who had run out of other options. So, when you buy KZIA stock today, you aren't just buying a lottery ticket on one breast cancer patient, you're buying a platform with two active clinical assets that are beginning to mature simultaneously. This depth of pipeline is what separates a pump-and-dump operation from a legitimate biotech turning a corner.